Welcome back, ladies and gentlemen. We've talked about long-term liabilities, and now I want us to talk about current liabilities. And first, let's try to understand the meaning of current liabilities. So, when we talk about current liabilities, we're saying that current liabilities are those that are due within a year. So, all those that you to pay in 1 year within current liability. So again, you are saying this primarily occurs part of regular business operations. So that one I can explain with the account receivable. The goods that you are getting from your suppliers that you're supposed to pay within maybe 30 days or 60 days. So we call them current liabilities. Then again, you are saying that due to the short-term nature of these financial obligations, they should be managed with consideration of the company's liquidity. So when you talk about the company's liquidity, here we are talking about the cash at bank or the cash in hand or the cash equivalents that we have within a company. So for example, maybe you've taken goods from a supplier and you are supposed to pay within 60 days. So that means that the goods that you are selling to your customers, you're supposed to give them a credit period of 30 days, or maybe you're supposed to sell to them in cash, such that after 30 days you'll be in a position to, rather you'll be having money that now you can pay your suppliers after 30 days. So you'll be getting your money from your customers for 30 days, and then after 60 days, you have collected enough money such that you can now pay your suppliers. So here's where we talk about company's liquidity. So we are asking, how liquid is the company to manage the suppliers? How liquid is the company to be able to be in a position to manage the current liabilities? Can you get money from your customers early enough, or do you have liquid cash that you can pay your current liabilities? Then again, you are saying that liquidity is frequently determined as the ratio between the current assets and the current liabilities. It's the ratio of the current assets and the current liabilities. So if your current assets is not enough to pay your current liabilities, you'll be saying your company is not liquid enough to manage your current liabilities. But if your current assets are in a position, or rather they are liquid enough to pay your current liabilities, then you'll be saying that your company, your business liquidity is okay, and it is in a position that can manage your current liabilities. So let's move forward. I hope you've understood what we mean by current liabilities. So we have quite a number of, we have categories of current liabilities. We have short-term loans, we have account payable, we have interest payable, we have income tax payable, we have accrued expenses, and we also have bank overdraft. So let's see what we mean by short-term loans. So when we talk about short-term loans, so short-term loans down here, when we talk about short-term loans, we mean loans the maturity over 1 year or less. So when you take a loan from a bank, you take a loan from a financial institution, but you're supposed to pay that loan within 1 year, or exactly 1 year or less. We are calling that loan a short-term loan. But when that loan is supposed to be paid over a period of more than 1 year, then it will be a long-term loan. Then we also have here income tax payable. So when we talk about income tax payable, we are saying that the income tax amount owed by a company to the government. The tax amount owed must be payable within 1 year. Otherwise, the tax owed must be classified as a long-term liability. So here we can talk about the sales tax, we can talk about the value-added tax, we can talk about the excise duty tax. So those taxes that you're supposed to pay on a monthly basis, or maybe after 2 months, or pay as you earn, you must pay after 30 days. So these are the taxes we are saying that they are these taxes we call them we are saying that they are current tax, so they are current liabilities. And then now income tax will come. When you talk about income tax, we are talking about the tax that you need to pay from your income after getting income from your income, your business. There's that portion that you need to take to the government, and it's supposed to be paid within 1 year. So we call that one current liability. Like now you've operated for a period of 1 year. Then after 1 year, you need to calculate your income tax for the whole year. And then that whole the income tax that you will have calculated after 1 year, you need to pay on the next year. So within that next year, it should be a current liability because it is supposed to be paid within that year. So when the interest income, rather the income tax is payable in a period which is more than 1 year, it qualifies to be called a long-term liability. Then we also have a bank overdraft. So this one is, or rather we are saying that it's a type of short-term loan provided by a bank when payment is made, or rather when payment is processed with insufficient funds available in the bank account. So maybe, for example, you have 30,000 in your bank account, but you are making a payment worth maybe 45,000 shillings. So when you make a full payment of 45,000 shillings and the available balance in your account is 30,000 shillings, it means that you are having a bank overdraft of 15,000 shillings. And then that bank overdraft is supposed to be paid within 1 year. It should not be paid over 1 year. When it goes over 1 year, we call it a long-term liability. And when you pay it within 1 year, it becomes a short-term liability. Then we also have accrued expense. So when you talk about accrued expense, you're saying that expenses that have been incurred but no supporting documentation like an invoice has been received or issued. So accrued expense can be rent. Maybe you're supposed to pay rent in January, but you've not received the invoice from the customer. And then in your books of account, you need to recognize that you've incurred that rent expense. You must record that expense, but you've not paid the expense. So when you put the expense in your books, but you've not paid for that expense, you are saying you are accruing expense. And the same applies to when you've taken a loan, and then the loan is earning an interest, but you've not paid that interest. So loan is earning interest on a monthly basis. So after each and every month, you're supposed to pay that interest. So when you don't pay that interest that you've incurred after a month, you will put in your books that interest. But since you've not paid this interest, we are calling that interest accrued interest, accrued expense. So accrued expense, you would have paid this expense, within that month. So we are calling it a current liability. So we've also talked about short-term loans. So let's just go back to current liabilities. So we talked about these four. So now we have interest payable, we have account payable, income tax. We talked about accrued expense. We've also talked about bank overdraft. So let's see account payable. So when you talk about account payable, we mean those amounts that are payable to our vendors or our suppliers. So for example, you've bought goods on credit, and goods on credit, maybe the supplier has given you a credit period of maybe 1 month or maybe 60 days, meaning 2 months. The 60 days or the 30 days are within 1 year, so we call them current liabilities. So here we are saying that these are unpaid bills to the company's vendors. Generally, account payable are the largest current liability for most businesses. So these are just the amount that you owe your suppliers. Normally, you get goods from your suppliers and pay them after 30 days or 60 days, and it is always a routine in the business. That's why we are saying that accounts payable are the largest current liability for most businesses. So these are current liabilities because they are due within a period less than 1 year. Then we also have interest payable, interest expenses that have already occurred but have not been paid. Interest payable should not be confused with interest expense. So interest expense is that interest expense is that expense that you are recognizing. So when you take a loan, there's that interest element. So you're saying maybe the loan that you've taken is having a interest element that is based on reducing value. So you've taken a loan of 10% and the loan is maybe worth 30,000, 10% interest. So after 1 year, when the loan is 30,000, it means that you're supposed to pay 3,000. But after 1 month, you're supposed to pay the 30,000, the 3,000 divided by 12. So on a monthly basis, we are supposed to pay 3,000 divided by 12. So when comes January, you will recognize you will have incurred an interest of 30,000 divided by 12. So you must put that one record into your books. But the interest payable is the amount that you're supposed to pay. So we are saying interest payable should not be confused with the interest expense. So the interest payable is the amount that you're supposed to pay, but the interest expense is the amount you're supposed to recognize in your business as interest expense. Unlike interest payable, interest expenses are expenses that have already been incurred and paid. So you can incur interest and pay, or you can incur interest and accrue it. So you will pay at a later date. So those ones we call interest expenses. You incur the interest and accrue it, or you incur the interest and pay it. So when you accrue it, it means that you will pay it at a later date. When you accrue it, it means that you are only recognizing the interest element in your books, but the payment you'll do at a later date. So we call it interest accrued. So we are saying the interest expense are expenses that have already been incurred and paid. Therefore, interest expenses are reported on the income statement, while interest payable is recorded on the balance sheet. So the interest expense is an expense. It has to be recorded in the income statement element. When you get your revenue, now you need to net off your expenses. So the interest expense will be part of the expense. So when it comes to liability, that amount that you're supposed to pay that you've not paid, it becomes a liability. So that one you need to record in the balance sheet. Hope, ladies and gentlemen, you understood. So let's proceed on. So now we've talked about short-term loans. We've talked about account payable, interest payable. So now let's talk about contingent liabilities. So what are contingent liabilities? So we're saying here contingent liabilities are a special category of liabilities. They are contingent to a situation, contingent liabilities. So we are saying that they are probable liabilities that may or may arise, may not or may arise, depending on the outcome of certain future event. A contingent liability is recognized if only both of the following conditions are met. Outcome is probable. The probability amount can be reasonably estimated. One of the most common examples of contingent liabilities is legal liability. So let me try to explain this with a legal liability. So let's say maybe you are trading. When you are trading, you are a businessman. You are doing your business operations, but you have a legal case in a court. Rather, you have a legal case. So a legal case, you can either lose or you can either win. It means that when you win this case, maybe the other person will pay you. It becomes a contingent asset. So the contingency comes here that you can only win at a particular date. So there's a probability that you can win, and there's a probability that you can lose. So at that point that you will lose, or that point that you will win, it becomes a liability, or it becomes an asset when you win. So let's assume that this legal case, you know very well that this case you will win, and you also know that when you win, you'll get this amount. So when you're sure that you'll win and you are sure that you'll get this particular amount you can estimate, so that will not be a liability. It will be an asset, but it will be a contingent asset. So you are in a position to know that you'll able to win, and you know the amount that you will win, you'll record in your books of account the contingent asset. But now that you know that you will lose, and you also know that when you lose, you'll be paying this amount, you should record that in your book as a contingent liability, because you know the amount you lose, and you also know that this case you must lose. So that's the explanation of a contingent liability with the perspective of a legal case. So ladies and gentlemen, we've talked about liability, or rather we've talked about current liabilities. So when we come back, rather I want us to stop at that. So when we come back, we'll be talking. We'll talk about a different topic. When we come back, we'll talk about revenue, and then we'll move to expenses. So thanks a lot for watching, and let's meet again on the next